everybody, Dwayne Britton from Mortgage Choice in Wantirna. The question I get asked the most, other than how much can I borrow, is should I fix or should I have my loan on variable? Really the answer to that will depend on your individual circumstances, but if I can talk generically or generally for a moment, is what we're finding is currently the fixed rates up to about 0.5% lower than the variable rates with the same lender, and that's pretty compelling. In my 35 years I haven't seen rates that low, nor have I seen the differential that low either between fixed and variable. So if we talk about the pros and cons of whether you should fix a loan, really the pros are we're going to lock in your repayment. You know what your repayment's going to be for the 2 or 3 year term, whatever it be. Also, if rates were to go up, we're fixed in at the lower rate. That's the pros. The cons around fixing is that if rates continue to go down, well then we're going to be fixed at a higher rate, albeit we're still a fair bit below the variable rate at the moment. The other negatives are we do lose some flexibility. So most banks will put a restriction on the amount of additional repayments we can make on a fixed rate loan. So that might be $5,000 a year, for example. So not ideal if we want to really pay down our home loan quickly. The other one is not many fixed rate loans will allow the capacity to have a fixed rate loan, an offset account onto the fixed rate loan. So we do have some lenders that will allow that, but that's quite rare. Okay, so that's really the main pros and cons. If we talk about rates at the moment, as I said, about 0.5% is the differential. So we've got owner-occupied rates fixed 2 years at 2.09, and we've got investment fixed 2 years for principal and interest repayments at 2.39. Really compelling. So what we're doing at the moment with a lot of our owner-occupied loans is that we'll split the loan. So if we've got a $500,000 mortgage, we might place $400,000 on it fixed for 2 or 3 years, generally no longer than that, and then we'll put the other $100,000 on a variable rate loan. That way we're getting the best of both worlds and we're locking away our cash flow, which is super. The other one is investment loans. So with investment loans, I think it's slightly different in the sense that when we own an investment property, it should be treated like a business, and really our main expense with an investment property is the interest cost. So if we get the ability to be able to lock that away and lock our cash flow away and our expense base, well then we really do, again, that is a compelling opportunity for us. So if we can lock in our fixed rate at 2.39, 2.49, whatever it be for an investment loan, again, I think that's well worth considering, because we generally don't pay or want to pay down our investment loans as quickly as if it was an owner-occupied loan. I hope that helps. Fixed, variable, it really depends on your circumstances. Happy to have a chat to you about that as to what it means for you. Stay safe, stay well, and we'll talk soon. Thank you.